just wanted to quickly run through the note published last night on Origin. So I won't go through all the details of the result, just to point out that it was a better than expected result in FY20, but obviously all eyes are on expectations for FY21. And there were some disappointments there. So the outlook for energy markets, so just to remind you, Origin only gives guidance for the underlying EBITDA of its energy market segment. It doesn't give an EBITDA figure for its integrated gas division, which covers the LNG business. But on that energy markets business, look, there's not a lot of transparent consensus figures out there because you've got to separate out that division from the other. But the numbers that I did see were very similar to mine. We were looking a bit higher by about 5% compared to the midpoint of guidance. The stock did close down 6%, but just bear in mind that's in the context of a weaker energy index yesterday, with names like Beach, Santos and Oil Search also falling about 4 to 5%. So the drivers for the guidance drop in energy markets, Origin pointed to about 170 million to 220 million gross profit decline in the electricity business, a drop of 100 to 150 million in the gas business, but there are some one-offs you've got to allow for there. So in the gas business, 70 million was coming from non-renewal of a transport deal Origin had done back in the day when LNG trains were ramping up. So that's not likely to be repeatable. And with the electricity business, there were about 40 million of network costs Origin had to absorb that weren't reflected in the semi-regulated default market offer. And while that drop in gross profit for electricity does, on face value, look bigger than AGL, with AGL you've got to factor in the Loy Yang movements year on year, so proportionally it's probably similar once you allow for that. The reasons why there's that drop in the electricity business, Origin pointed in the management call to potentially C&I customers having shorter durations at the top of the market. So C&I customers not locking in for as long when there's higher prices, which means that the drop in prices flows through the book faster than I think a lot of people were expecting. And also they pointed to potentially lower generation output at Eraring in the year ahead. So overall, I think my thinking hasn't really changed all that much. At this level, I do see medium-term value, but I don't see an earnings recovery until second half 22, potentially FY23. There is possibly some upside to my figures if FY21 is actually the low point of earnings, but I think domestic electricity prices are really going to be the big swing factor. If we keep seeing summer volatility in electricity prices, then retail customer margins will probably hold up. However, this summer, if we don't see those spikes, then we could continue to see a further fall in earnings next year. So ad ratings retained with a slightly lower price target.